A lectures in corporate finance, dividend policy. In these lectures, we're going to explain why investor prefers dividend. We are going to discuss theoretical frameworks that can be used to explain dividend policy of the companies. In particular, we're going to discuss about the signaling hypothesis, the clientele effects of dividends, and the Kettling theories of dividends. Then in the next sections, we're going to use a residual dividends model to set up the dividend policy of a company. In the last section, we're going to discuss characteristics of stock dividend and stock split. We also discuss the pros and cons of stock repurchase as an alternative of cash dividends. What is the dividend policy? It is the decisions to pay out earnings versus the decisions to retain and reinvesting the earnings. The company have an alternative whether to pay out earnings as dividend or retain them for future investment. A discussion of the dividend policy includes whether the company set up dividends payout ratios. For example, a mature company may set a high dividends payout ratio, maybe at least 50% of the firm's earnings. Or some growth firm may decide to set a low dividends payout ratio. It could be less than 30% of the net earnings. In some particular situations, the company may have special dividend in addition to the regular dividends. If the company earns extra cash flow from the operation or from selling its subsidiary, it may decide to pay special dividends to the shareholders. For how frequent the firms pay dividend depends on the dividend policy of the firms. In addition to the annual dividend, the firms may decide to pay an interim dividend. In Thailand, for example, the fiscal year end is December 31st. The board of directors may meet and decide on the dividends payment during February or March, and that would be the decisions on annual dividends payment. After the operation for 6 months, from January to June, the board of directors may consider the firm performance and decide to pay an interim dividend. This interim dividend will be based on the firm performance during the first 6 months of the year. For some situations, the company may pay quarterly dividends. This may provide stable incomes to the investors. It is the announcement of the policy that matters. When the firms make an announcement on the dividends payment, it will have an impact on the firm's stock price, whether the announcement is good news or bad news. We're gonna start a discussion of theoretical frameworks by looking at the dividend irrelevance theory. This is proposed by Montiglis and Miller. In this theoretical concept, investors feel indifference between the firm's dividend and the capital gains. When the firms have positive earnings in that particular years, the firm may decide to pay out earnings as dividend to the investors. Or the firms may decide to retain the earnings to support investment for future growth. In the latter situation, the stock price of the firm will increase in the future, providing capital gains to the shareholders. Under the dividend irrelevant theory, investors do not care about the firm dividend policy. If investors want cash, investors can sell the stock and get some cash. If investors do not want cash, investors can use the cash dividend to buy additional stock and wait for future capital gain. The dividends irrelevant theories provide a good starting point of the firm's dividend policy. However, it provides unrealistic assumptions because it assumes that there will be no taxes and there will be no other transaction costs. Investors can buy and sell stock with no transaction cost. Comes to a more realistic situation, we understand that investor prefers dividend. We're going to find out some rational explanation why investor prefers dividend. When comparing between dividends and capital gains, dividends are less risky. When the firms make positive earnings in that particular years, investors want the share of profit. Investors prefer firms to share the profit in the form of cash dividend Because the future is uncertain, when the firm retains earnings for additional investment to support future growth, the potential of future capital gain is not as certain as the cash dividends right now. In this situation, investors will prefer firms that offer high payout ratio. For companies that offer high payout ratios, the stock price will receive positive response from the investor. For the signaling hypothesis, investors look at dividend increases as a positive signal. It provides signal of the firm futures. When the managers decide to increase the firm's dividend, the managers must be certain that it will be able to maintain that high level of dividends payment in the futures. Because the manager hates to cut dividend, by doing that, it will receive negative reaction from the investors. With an announcement of dividend increase, stock price will react positively. Pretty much, it reflects a higher expectation of firm futures earnings. Next, the clientele effect. It is said that there are different groups of investors or different clienteles. Certain investors will prefer firms with certain dividend policy. Under the clientele effect, the firm's historical dividend policy will determine its current clientele. If firm offers high dividends payout, it will be attractive to particular types of investor that prefers high payouts dividend. The clientele effect suggests that firms will not change its dividend policy too often. The dividend policy is sticky. Once the company has established its clientele of investors, the managers doesn't want the investor to switch their invested companies. The most recent explanations of dividend policy is the Kettling Theory of dividends. This theory suggests that investor preference for dividends vary over time, depending on the market conditions. For some times, investors may prefer dividend. If that's the case, corporate managers are likely to initiate dividend to cater to the current desire of the investors. The dividend policy is therefore set to favor the firm investors. If investor prefers capital gains because of tax reasons, then the company may decide to ignore the cash dividend, retains the earning dividend for future capital gain. This is the Kettling theories of dividend. In this section, we're going to discuss the Residual Dividends model. This Residual Dividends model can be used by the company to set a dividend policy. The first step in setting up the dividend policy is to set up the company capital expenditure or capital budget. Whatever left from the retained earnings is called the residuals that can be paid out as dividends. The residual dividend model has some advantage. This approach helps the company to minimize its cost of capital. The firms will be able to minimize the flotation cost from equity issuance. Let's take a look at the relationship between the dividends payment, the company's net earnings, and the company capital budgeting. In the residual dividends model, the company must first set a capital budget. Let's say the capital budget is $800,000. Then the company will decide how much of this capital expenditure will be financed by debt and by equities. In this numerical example, 60% of this capital expenditure will be financed by equity. 60% of $800,000 is equal to $480,000. Then the company expects to make a net earnings of $600,000. This is a forecasted net income in the coming year. Based on a capital expenditures of $800,000, $480,000, which is 60%, will be funded by the equity. The company must retain $480,000 from their expected earnings this coming year. Whatever left can be paid out as dividend. In this example, the expected dividends payment is $120,000 based on expected earning of $600,000. That represents a dividend payout ratio of 20%. This model has some serious limitation. The dividends payout ratio will vary depending on the expected net earnings. For example, if the company expects to make a net earnings of $400,000 based on a capital budget of $800,000, that 60% will be financed by the firm's retained earnings. In these situations, the retained earnings will be in shortage of $80,000. The companies will not be able to pay out any earnings as cash dividends, so the dividends payout ratio will be equal to 0%. On the other hand, if the expected net earning is equal to $800,000 with $480,000 retained to support the capital expenditures, the firm will have $320,000 left for cash dividend. This would represent a dividend payout ratio of 40%. We see that under these three scenarios, we fix the capital budget with $800,000 and 60% will be supported by retained earnings. When the expected net income is equal to $600,000, the dividend payout ratio will be equal to 20%. If the expected net earning is less than $600,000, the dividend payout ratio will drop. For example, when the forecasted net earning is equal to $400,000, the dividend payout ratio will be 0%. But with high expected net earnings, the dividend payout ratio will increase significantly. The residual dividend model therefore has some significant disadvantages. It results in Residuals Dividend Policy. This may send a conflicting signal to the stock market. And based on the clientele effect, it does not good for the company clientele of investors. The good things of this model is that it minimizes the new stock issue and the associated transaction cost. How the companies apply the residual dividends model. It can use the residual dividend policy as a starting point, but it doesn't have to follow it strictly. Let's take a look. First, the company may forecast the capital expenditures needed over the periods of 3 to 5 years. This provides the ideas of the amount of capital that will be needed over the next 3 to 5 years. Then come back and look at the target capital structure of the firms. What proportion does the firm's capital structure would be financed by debt and what proportion would be financed by equities? Based on number 1 and 2, the managers can forecast the amounts of equity needed every year over the next 3 to 5 years. Then the company can apply the residual dividends model to set a target dividends payout ratios over the next 3 to 5 years. And this ratio doesn't have to be sticky. It may be changed to accommodate future circumstances or any emerging corporate event as a result of changing corporate strategies. Now we have an example of Siam Cement Group. Since 2004, the company has been able to maintain a dividends payout ratios between 40 to 50%. Specifically, we can look at during the years 2004 to 2007, the companies maintain a fixed amount of dividends. This provides the dividend payout ratio between 50 to 60%. Then, after the financial crisis kicked in 2008, the dividends amount varies depending on the company business performance, but still the company will be able to maintain the dividend payout policy in the neighborhoods of 40 and 50%. During 2014 to 2019, the dividends payout ratio ranged between 40 to 50%, and this continued even during the COVID-19 crisis in 2020. We can see that the amount of dividend vary depending on the firm business performance. Looking at the company business performance over the past 15 years, the company's dividend policy is set between 40 and 50% of the net profit. So the dividends amount varies up and down with the company's net profit. Now coming into the last sections of the lecture, we're going to discuss characteristics of stock dividend and stock split. For stock dividends, it is an alternative to cash dividends. In some particular years, the company may have to maintain cash for its liquidity. In this situation, if the company decides to pay dividends, it may offer stock dividend to the investor. Let's say for the 10% stock dividend, if investor have 100 shares, it will receive 10 additional shares. Then the overall number of shares outstanding will increase by 10%. This may cause a share dilution. The value per share may drop. For stock split, it will also increase the number of shares in the stock market. Let's say for 2-to-1 split, investor that own 1 share will now have 2 shares, receiving 1 additional share for free. For 10-to-1 split, from having only 1 share, investor will have 10 shares, 9 additional shares for free. This will result in the share dilution effect. The value of share will drop in response to the ratio of stock split. For 2-to-1 split, the value of share will drop by 50%. For 10-to-1 split, the value of share will drop to 1/10 or 10% of its original values. Both stock dividend and stock split will increase the number of shares outstanding in the market. If the value of the firms remain the same, the pie will be divided into smaller pieces. The value per share will drop so that the investor wealth will remain the same. Stock split and stock dividends may provide additional trading liquidities in the stock market. Because when the share price is less expensive, it may result in more trading volumes in the stock market. It is believed that for some companies that have expensive stock price, by having a stock split, the number of shares in the stock market will be more available. The share price will drop, allowing more investors to participate in the buy and sell of the company shares. For stock repurchase, this is also considered an alternative to cash dividends. Stock repurchase occurs when the company buys its own stock back from the shareholders. A reason for stock repurchase may be because the company wants to make some changes on its capital structures, or maybe the company have the stock option and the holders of the options want to exercise their right, converting the options into the company's stock. For the stock repurchase, the firm's stockholders may decide whether to tender or not tender its share. This is not compulsory. It is an option for the stockholders. A majority of the corporate managers think that stock repurchase sends a positive signal to the market. Because the firm invests in its own stock, it must be the reason that the company's stock is undervalued. The company has sufficient cash. It can pay out this cash as dividend, but it decides to repurchase its own stock. Corporate managers see the value of this stock repurchase program and want to send some signal to the stock market investor. Oftentimes, an undervalued stock price is a major reason behind this stock repurchase program. The corporate managers may decide to repurchase its stock. This is to avoid setting out a high dividend payout ratio that cannot be maintained in the future. Because in the future, the company may not have extra cash. This extra cash could be a one-time only. So it may initiate a stock repurchase program rather than paying it out as cash dividends. At the end of the lectures, the exercise involves the use of the Residual Dividends model to determine the relationships between the capital budget and the target dividend payout ratios. Additional information is in this slide. Good luck.